Okay, so this is the final part of the series on creating or building your own strategies. Okay, and without further ado, let's jump on the charts. And I will be starting with price imbalances and order blocks. Now, this is a term that has become very popular in the trading space. I think most of the traders that trade imbalances tend to be ICT traders or SMC traders. I sometimes actually don't know the difference, but regardless of what they are called, the fact remains that the market reacts. The market reacts to imbalances. Period. Okay. You may ask, what is an imbalance? I will give you an example. Let's magnify this. Now, I think this is a good example. No, maybe I won't use that. Let's use a clearer example before we start looking at the more complicated ones. Okay, now let's look at this bar here, this green bar here. We can see this bar opened here, closed here, went as high as this, creating this wick. This is the wick, this is the top wick, this is the bottom wick. Okay. And then the bar before opened here, closed here, and then created this top wick, created this bottom wick. The bar after this bar was another green bar, opened here, closed here. This was the small top wick, this was the tiny bottom wick. Now, an imbalance is when price moves in a certain direction in the market so quickly that it doesn't come back to close, to revisit areas that it left. I'll explain. Now, when you say a market is balanced, it means when price paints a bar like this and then paints another bar like this going up, and then on the third bar, before the third bar completes, it would come back down to touch the top wick of the first bar. Okay, so let's call this bar 1, call this bar 2, call this bar 3. If the market was balanced, this bar, this green bar here, which is bar 3, before it came back down, before it closed here, bar 3 would have come back down to touch this wick of bar 1. It doesn't have to touch it. It can go all the way down, but it will reach it. It doesn't have to bounce off it. It will reach it. Okay. If that happened, if price came back down and touched it or went further down before closing back up, then we would say this area of the market was balanced. At least within these 3 bars, there was no imbalance. Okay. Now, but because price was moving very quickly up, signified by these green bars, price didn't come back down to touch this wick here, the top of this wick here. It didn't. It just continued going because the momentum was high. At such times, when there is a distance, when there's a gap between the high of the first candle and the low of the third candle, so from here to here, so this space here, when that occurs, then we say there is an imbalance in the market. We say there's an imbalance in the space of those 3 bars, not just in the market in general, in the space of those 3 bars. Okay, so looking at those 3 bars, we would say there was an imbalance here. So between these 2 lines, there was an imbalance because this wick here of the third bar didn't come down to touch the wick of the bottom bar, of the first bar. Okay, now, before I talk about price bouncing off, let's talk about the same thing in a downward move. Okay. Now, if we take these three bars, so 1, 2, 3, can you see this closed here? This next bar was formed, closed here. This third bar was formed, closed here, but it didn't go back up to touch the bottom wick of this first bar, which means there was an imbalance between here and here, an imbalance between here and here. Okay. Now that I've explained imbalances, let's look at what the market does with imbalances. Again, remember, these are random examples. I haven't planned these examples. Okay. So if by picking random examples, you can see how the market works, then you should start to think to yourself, if random examples can work this well, I wonder what will happen if I actually do my back testing and analyze and create my strategy with set rules, laid down rules, and yeah, the sky is the limit. Okay, so back to this imbalance here with these green bars, you can see how price created this imbalance here, moved up, but came back down. Where did it bounce off? It bounced off this imbalance, went up a bit before coming back down here. Okay, I'm not even going to belabor that. Let's move to this imbalance here. So you can see, so the imbalance of the red bars, of the down bars. An imbalance was created here. Can you see how price went down, came back here? Where do you think it bounced from? It bounced from this imbalance, went back down. Now, there is a modification to this because the imbalance didn't actually stop here. The imbalance actually continued to here. And that's because there was also an imbalance between the top of this red bar and the bottom of this green bar. So the imbalance actually started here and went all the way down here, but actually didn't end there. It continued all the way down here, because between here and here, there was no instance where price actually went back to touch the high of the first bar. So I'll give you an example. I'll explain further. Taking this as the third bar, this as the second bar, this as the first bar, the wick here never went up to touch this wick. Taking this as the third bar, this as the second bar, this as the first bar, the wick here never went up to touch this wick. Taking this as the third bar, this as the second bar, this as the first bar, the wick here never went up to touch this wick. So that's why we will consider this whole space here as an imbalance. And you can see what price did. It went up, bounced off this imbalance, and went back down before going back up. Okay. Now, very closely connected to imbalances are order blocks. Okay. Now, an order block in an upward trend, an order block is so in an upward trend, remember you would have green bars. Okay. An order block in an upward trend is the last red bar that was formed before the upward trend started. And I'll give you an example. Let me delete these arrows first, okay, or these lines. Now, looking at this, you can see a series of green bars here. And that all stopped here. So price went up for a bit and stopped here. But before price actually started forming these green bars, what happened? A red bar was formed. This red bar before the series of green bars is the order block. Okay. In a downward trend, the reverse is the case. You can see a series of red bars here formed. Before these red bars were formed, what happened? A green bar was formed. This green bar here is the order block before these red bars were formed. Now, price reacts to order blocks. You will find this everywhere, littered all over the charts. On the 1 minute, 5 minute, 15 minute, 1 hour, 4 hour, daily, weekly, and monthly charts. They are everywhere. Okay, but it doesn't mean you should trade everything. You can't trade all of them. You have to find out the ones that are the ones that are the most probable to work. Okay, so just given this example, price went up, created this order block here. Let's just create. Now, with order blocks, the body of the order block tends to carry more weight than the rest of the order block, than the wicks. So looking at this order block here, the body here tends to carry more weight than this part, the top wick or the bottom wick. However, the whole block, the whole candle is the order block. Okay, so you can see how price went up, came back down. Where did it bounce off? It bounced off the order block. You can see how price bounced off here. Now, the reason I said the body tends to carry more weight is because when price bounces, you can see it bounces off the body. It didn't reach the wick here. Okay, it didn't reach the wick here. However, sometimes it does, and then it bounces off. Okay, so again, it's back testing to find out which are the most probable to work. So price bounced off this bullish order block here. Okay, delete those. Let's see if price bounced off this bearish order block here. So remember, I said that these were the red bars, the downward moving bars, and this was the order block before these red bars formed. Now, okay, we can see, like I explained before, price came back up and bounced both off the imbalance, but also bounced off the order block. Can you see how to the pip this bounce almost was? Very close to the body of this green bar. Of course, it bounced off the whole bar, but almost bounced off the actual body of the bar, which is why I said sometimes it bounces off the wick, sometimes it bounces off the body. Okay, so it bounced off and went back down, and then went back up to break it. Okay, so that's it with imbalances and order blocks. Now, the last thing I'm going to mention, the last tip I'm going to give you is gaps, overnight and weekend gaps. A gap is a simple concept. A gap is basically when price shoots in one direction and creates a space where price hasn't actually visited. Okay, I'll give you an example. This tends to happen mostly on weekends, and not all weekends. Happens mostly on weekends. Sometimes it also happens overnight. Where are you? I'm looking for a very clean one. Okay, I could easily have given you this one because this is actually a gap. But the reason I'm not giving you this is because the wicks overlap, and that might make it confusing for you if you don't understand what gaps are. It's after you've understood the basic workings of a gap that you can then start to look at more advanced gaps like that. Okay, now was this a weekend? Yes, this was the 5th of June, this was the 8th of June. Now, separated by this vertical line here. Okay, let's bring it up a little. Yeah, that's better. Okay, so you can see that price closed here on the 5th, price closed here. On the 6th, on the 8th rather, which was the next week, price opened here. You know, normally if price closed here, you would expect price to open very close to it, but that didn't happen. Price gapped down. That's what we mean by gapped down and opened here, creating a gap between here and here where it opened. You can see the space here. That is clearly a gap. Okay, price could also gap up. It doesn't have to gap down. And a gap up would be price closed here, and then maybe this week it opens here, creating this whole space here. Okay, now price gapped down and then went down a little further. But what happened? It then came back down to close this gap. You can see how price came back and closed that gap. Now, the market always tries to close its gaps. Doesn't happen all the time, but it tries to, but it doesn't succeed all the time. Okay, that's one thing you should know. So look at the charts, study gaps, and try and understand what does it do when it's trying to close a gap. I have three strategies based on this singular concept. Three strategies, because I studied gaps and I realized, wait a minute. Tip: the strategies I have are on the hourly chart. Okay, I studied gaps and realized, wait a minute, on every instrument, mark my words, every instrument, not just Forex, indices, I studied on multiple instruments, and I realized that before price closes a gap, it does certain things on the hourly chart. The strategies I have with gap trading, do you know how well they work? I have a strike rate of 85% on those strategies. And that's because I spent time studying gaps and trying to understand what happens before a gap is closed. What happens when a gap is not closed? What happens when a gap is closed and then it reaches a support? What happens when a gap is closed and then it reaches a resistance? There are so many ways to build strategies of gaps. I also have multiple, I have, I think, three other strategies on imbalances and order blocks also. Okay? Just to tell you that you can create your own strategies, strategies you believe in. Okay? And that is it. That is it. Study gaps and understand why do you think price is not moving anywhere? Why do you think price is just hovering here around this gap? What is it doing around this gap? Okay, those are the questions you should be asking yourself. Let me see, just before I end this video, see if I can find another gap, another clear gap. Yes, you can see there's a gap here, but it's not a big one. The best gaps are the biggest, are the bigger ones. Okay, so you can see 25th of May, 26th. This wasn't actually a weekend. This was overnight. And you can see a gap was actually created here. Price closed here and then opened here. And can you see price didn't go back to fill the gap, which is why I said it tries to fill it, doesn't fill it all the time. Now, we might be able to go forward in time and see that price has actually filled it. But yes, perfect. Look at this one. Look at this gap. Now, this was a weekend. This is where price closed here. This is where price opened here. Can you see the clear gap? There's a clear gap between the 22nd of May and the 25th of May. Okay. Now, okay, let's actually see what price did afterwards. Can you see price did not close this gap? It went up and just kept going. Okay, let's crunch this up. Can you see this is the beginning of the gap? This is the end of the gap. Let's see what price did. Can you see? It broke the gap. So after doing all this, acting like, oh, I don't like you, gap. I don't like you. I don't like you. I'm not going to come near you. But what happened? Price came all the way back down, broke the top of the gap, acted like it was never going to fill the whole gap, went back up or came back. What did it do? It completely filled that gap, bounced off to the T and went up before it came back down to break. You just can't fake this. That's the market for you. The market leaves clues. The market tells you, yes, you might not be able to find a gap every minute of the day, but if you just settle down and study what the market is doing around gaps, you realize that there's a gold mine there. There is a gold mine. And that's it. So I've given you how many? 1, 2, 3, 4, 5. I've given you 5 tips on creating strategies. You don't need all the 5 tips to create a strategy. You only need 1. You can combine 2, you can combine 3, you can combine all the 5. It's up to you how you want to create your strategies. But whatever you do, back test your strategy. And do not back test for 2 months or 3 months. Back test properly. Back test for at least a year. and you will see that you have a an amazing strategy that can serve you for years and years. An amazing strategy that you will not have to hop from it to another strategy. An amazing strategy that you will be confident in because you built it yourself. It wasn't built by some random person on the internet and then you took it and tried to make it work. It was built by you. And one important thing is because you built it yourself, if it stops working or if you realize that it's not working as well as it used to, you will be able to tweak the strategy or make a few changes to make it work again or to make it better or to make it perform better because you created it. You created it, so you believe in it and you know that it works. So if things go wrong, it's as easy as going back to the drawing board and finding out what has broken, what is not working anymore, tweaking it, and redeploying that as your new strategy or your updated strategy. But that's because you built it. Okay? That's it.